All right, stocks finished the week with a two-day win streak that really puts us on the precipice of some pretty significant bullish signals on a lot of these different charts that we look at day in day out. So I'm going to break that down and show you just how close we are, how many have now kind of flipped the switch from this bullish or bearish trend, correction we've been on to now ending the correction, moving back up to new highs. We'll talk about what we kind of need to see, what we need to see this week in particular to confirm this two-day rally and actually flip that switch completely and actually be all aboard the bullish train to the upside. And how likely I feel personally that is to happen. So I'm going to share with you what I'm seeing, what my expectations are, and why, based off of, again, generally the same charts we look at every single day. So that's the beauty of kind of this disciplined approach is lots of things can come up here and there, but if you're looking at the same stuff every day, you can kind of see and not get driven back and forth by new themes or new narratives or new whatevers. You just kind of pay attention to what you pay attention to and what those signals are telling you. I'm going to show you what these signals are telling you today. And then again, like I said, what I expect will happen this upcoming week. With our trade idea on the stock, that's also kind of at its own precipice. And we'll talk about the idea of how to trade that when it's at that point and what our risk reward can be. So let's go ahead and get started. Today is Friday, March the 3rd, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video I do at 3:30 Eastern time on these days that I do the Market Outlook videos. Come down here to the bottom, click this heart, it opens up this tab, hit that like button. Same thing here with this thumbs up icon. It opens up this tab, hit that like button there. Again, the more you do that, it really helps us out tremendously. It helps get our content out to all of our followers using the algorithms that they have. So those who like those videos day in and day out, thank you very much for doing that. For those who don't, you can do it right now while you're watching this with one little easy click here. All right, let's take a look at the S&P 500 with the market forecast indicator. There's your two-day rally, and we came really close. This is the vital key for the S&P 500. You got this bull tag here on the market forecast, which is what you get when the intermediate line crosses out of the overbought territory, so below the 80th percentile. That gives you the light pink shading as it's dropping between 80 and 50. Once you cross below 50, it turns dark pink. So we've gone from dark green, which is anytime you're above 80, no matter what it's doing, up, down, sideways, doesn't matter. Anytime you're above 80, you got dark green. You cross into light pink. You cross below 80, you get light pink. You cross below 50, it turns into dark pink. So anytime you get light pink and a yellow line, which means you close below a rising moving average, or you close, in this case, below a rising moving average, or you close above a falling moving average, you can also get that yellow line there as well. So you get the bull tag when you close below the moving average, when you're just kind of barely bearish, basically. That's typically either the beginning of a bearish move, in which this has been. It's been very weak. It's been short, but you do have dark pink shading and a red line for multiple days. So it's shorter than this one, and that was weak too compared to some of the other intermediate declines. But it is technically an intermediate decline. Would be a higher low point if this is the end of it. But so that bull tag can either lead to an intermediate decline or start a really strong bullish move to the upside. Really strong, like Tom Lee strength. Rally that we hear about all the time for the last however many 8 months or so. Every time they bring him on, it's always all-time highs by year end. It's just year end 2022, or now it's year end 2023, and so but that's the kind of rally we can get if we get this bull tag. Well, we did get a bull tag, but we kept going down. We got down to lower lows. We didn't quite break the 2.5% mark that really starts the intermediate decline. See, we did over here. But we never really did this go around. We got to 2.47 is the lowest point that we got to right there. And then we bounced back up. In the last 2 days, we bounced back up pretty sharply to the tune of the momentum in near-term lines really jumping up to high levels, which would be very strong, very, very good. Intermediate lines obviously turned higher, so now we have light green shading because we are not in the reversal zone, and we've turned up. We still haven't crossed 50 yet, so we are light green shading, and you can see the near-term line did get above the intermediate line, but the intermediate line is still well below market sentiment, so it needs to stay up here long enough to get the intermediate line to come up here too. But the key is that we close above the high of this. And basically, because this is where we get this gap, here we got this gap on 217 down to 221. You can see the gap right here when we go to the intraday chart. This runaway gap right there on 221 coming out of the holiday, right? If we fill in that gap, see, we are right up to it now. We basically finished right at the high point of last week, which is the gap, right? The opening gap from President's Day. So if we were to fill in that gap and basically nullify the runaway gap and close above that high point, which would give us a close above the bull tag, then that is really bullish, like really bullish. So we'll see. I mean, we've gone from that's not very much of a possibility to we are right there within 2 days. So, I mean, this has been a pretty dramatic run over the course of 2 days. So we'll see if we can actually make it up to the upside. Just to kind of give you an idea. So I put this together. This is the S&P 500 at the close on Wednesday. We were at 394.74. The VIX was 2 points higher. And this was on Wednesday at the close. And this is now through the end of the day today. So it was a one, like you can see the move that we've made to close here at 404.94 was we had a 6% chance that we would do that, just a little under 6% chance. So more than one standard deviation, not quite as much as 2, a little bit less than 2. So kind of in between the 1 and 2 standard deviation moves. Maybe you could say a 1.5. Because again, 6 times, that'd be like an 88% chance. So probably a little closer, maybe 1 3/4 deviation away from where we were on Wednesday. So needless to say, this was a stronger than expected move over the last couple of days. Very good. Brought the momentum in near-term lines higher and put us on the cusp of a breakout, right? At 404.16, we're technically above it at 404.19 on SPY. On SPX, it's a little bit, it's not quite there on SPX. Here it would be 452.35, and we're at 40.45. So, again, plus or minus a few points. We can't just close a point above it. We need to get through it and stay there, right? That's the signal. That would be the reversal signal. But you see just how close we are to that. On the weekly chart, it's not surprising that you have some a bounce in the momentum too. Again, we had this little reversal candle last week. We closed below 3 weeks worth of lows, and then we bounced back up. Again, did not close above last week's high. That's where the gap is, but we are there. The intermediate line is still rolling over. The near-term line is still down. But if we can bounce up and get above these lines, you'll see there's more significance too to this high point in just a minute. But if we can bounce up above that and get above those lines and get the near-term line back above the intermediate line and into overbought territory again, great, right? Again, we are bouncing back up. We get a move. We're already above the moving average, obviously. We are more than 2.5% above it. So, we are set up to do something, to be really, really good here from the S&P 500's perspective. Let's look at the NASDAQ. You can see we are back above we did close above that bull tags high. It was 12,257, and we're at 12,290. Light, dark green shading and green line. See, that's why important it is to get back above that, because you can see what it does. It gives you dark green shading and a green line. We are 0.5% above, but that's good, right? That the near-term line is clearly across above. The intermediate line's rising. It's already back above 50. I mean, that's bullish, right? Very, very bullish. The Dow Jones Industrial Average, which has not been as bullish and was not very bullish today. It was the laggard today out of all of these. is still below its moving average, is nowhere near its bull tag high point. It has light green shading, but barely above 20. And you can see the near term line, again, exceeding the momentum line is not what you want to see from that perspective. And then finally, the Russell 2000, which has also been relatively bullish here, also getting you the green line back above a rising moving average. Not quite the dark green shading yet, because the intermediate line is not quite above 50 yet. We're also not quite above that bull tag's high. That was a much bigger bull tag, big move to the downside, so we're not quite above that high point either. So we're close, right? We're so close to really turning this around. This chart here, which remember was on the cusp of a all week long, was on the cusp of a death cross after just barely getting a bull cross, avoided the death cross. So we had 2 strong days that avoided the death cross. So we actually closed back above the 10-week moving average. That's why you got the green arrow there. It is you can see we went from a close there at 4,004.46, and we got a close here at 4,003.61. So it is a slightly lower close. So we still need to get the higher close. But if we can close above this body, even with the lower close, I mean, that would be a significant reversal. Again, considering that's a pretty bullish candle there. The candle, I mean, and if we get a bullish candle, the Hakinyashi differential here would be obviously above 0, which means we'd be crossing above its moving average, and then we would be, potentially starting to move this 10-week moving average back up, right? And getting the golden cross and expanding that golden cross that we see there. Remember, the Dow Jones Industrial Average already has had, here it's easier to do it this way, the Dow Jones Industrial Average already has had this golden cross, did not get that green arrow here, but has been above this for quite a while. The NASDAQ has not had its golden cross and is on the cusp of it here. So you can kind of see how some the Dow's been a lot more bullish, and NASDAQ's been a lot more bearish, and we'll see who catches up to who. Let's take a look at the 3 green arrow charts. As you can see, again, we have a green arrow on the Qs and on the Russell. Remember, they have the green line already. So we have, and the Russell's got the green arrow on the stochastics too. So we have 2 green arrows there, 1 green arrow here. So we don't have the light pink shading anymore. We still have 3 green arrows, even though we're very close to getting at least 1 on the MACD there, on the stochastic here. So we're close to not getting light pink shading. And again, we need to get the 3 green arrows to get the dark green, to get the green shading again. And it needs to be more than just a day. It needs to get 3 green arrows and then stay for a couple of days to solidify the trend change, in this case back to the upside. But again, you can see how a close up above this and filling in that gap would do that, would essentially do that. That's how important that close is. Here's another reason why closing above that bull tag high would be so important, because you would also be above, again, all these moving averages, above the point of control. Right now we're essentially just filling in gaps. We would no longer be filling in gaps. If we were on the cusp of breaking the 200, we're no longer filling in gaps there. Here we'd be breaking above the 30, we'd be no longer filling in gaps there. Like, this is a close above 2 moving averages, the 8 and the 17-day. Not quite the 30, but that's still a pretty strong close. The MACD set for a bullish move, a green arrow, and then your stochastics already, also very close to a green arrow with its moving average. So you see how good this looks. You look from a stochastic standpoint, we are that close to getting into the upper half of the chart of the 4-week range and crossing above the moving average, which are both bullish, and we'd be doing it at the same time. So if we can on Monday, really follow through with this, fill in that gap and get going, I mean, we are set up for a really good move to the upside. Looking at some of the other indicators, the DMI looks positive. Look at that positive indicator crossing back above any high point the negative set, and the negative indicator almost getting below the lowest point the positive indicator set. So you've really almost got the switcheroo here with a really low ADX that is setting up for a breakout move. Which 2 days ago in this video we were looking to the downside, because that's where we were leaning. You see how 2 days can change that lean. Now, are we going to break out to the upside? Again, I'm not in that camp yet. I'd have to see it to believe it. We've seen a lot of fake outs this year, and is this going to be another? this has a lot of makings of another fake out. So I'm still not I'm in the camp of not buying into this until I see that this is not a fake out like all the others have been. Let's take a look at some of these other indicators. The hull has turned positive with a strong bullish Hakunashi candle. You can see the MACD above its moving average. This is where, to the 200-day. So it's a strong reversal pattern. Again, the weekly had just barely turned that parabolic star down. So, we'd have to flip, but we never did turn red on the hull. So again, you can see how that can change course here next week. I already showed you the stochastics move there. Another one was the McClellan oscillator. It got up to negative levels. Like I showed my class today in technical analysis class, during a lot of these declines, you can see during this intermediate decline, or even during this week intermediate decline, the McClellan oscillator went positive, and then it went back negative. This one, we had a strong bearish move, then it went positive, and then it went negative again. During this decline, you can see we had multiple positive moves on the McClellan oscillator, even a big move, even up above 100 before it went negative again. And then on this initial one at the beginning of the year, again, we had a strong bearish move, we went positive, and then stayed negative until it finally got above 35. So it's got to get positive, it's got to get above 35, and again, that's just David Settle speaking, anecdotal number there, to change the trend. And so far now this is the first day that we're not below minus 35. So that's good, but it's not trend changing. And especially considering that after breaking up above 1,000, we should have stayed above positive 500 for a good chunk of time. That really solidifies the change in trend. And the fact that we had a fake out there, and this is even a worse fake out here, we're already back below 500, still gives you concern, and still gives you concern when you're looking at the money flow, because the money flow has just been abysmal. It is rising. We're out of bearish territory. We're still in the lower half, but at least we're above 40. But you also notice that when you look at like the last time we were at this level, so you probably have to go back to like right here. This would be 126.23. This is where we were on. So I guess it would be right there, 126.23. That's where your money flow is. So again, through the ups and the downs, we are not at that level now. So we still haven't exceeded that level here. If you go all the way back to over here on 11.23, this is, again, we were at 402, so we're 2 points higher than we were there. But you notice we're nowhere, through multiple ups and multiple downs, we are still nowhere near that level of money flow. So we're still not getting the volume to the upside. Plenty of volume to the downside, but not enough to the upside to really solidify the change in sentiment. The breadth still isn't above positive. I don't think this is completely updated, the new highs and new lows. Let's take a look at it really quick. We did. It is. At least it's updated. I think the New York Stock Exchange updates theirs first. This is the combination of the New York Stock Exchange and the NASDAQ composites. We have to watch this a little bit later this evening. But that's a good sign to get above 100 and get above its moving average. So it can't be just a one-day deal. And then we'd love to see the skews break up above its moving average, and it didn't. In fact, it's actually even lower now. So that's an issue too. The skew should, as you're rising, you notice the skew should jump above its moving average as we're rising up to these peaks, and the skew is actually still dropping. So that's not necessarily the best sign either yet for that, for this kind of sentiment change. Looking at the move here, remember, you once you get the break to 100, once you're at 100, you have to wait for 6 days for the red line to get below 70. The green line's already hit 0. You're still low. Right? You never did expand the channel, so we're still set up for a move. It's just now there's the possibility that move can be to the upside, because you notice we are near the midpoint again. If by the end of next week, even if we don't get a new 4-week high point, by the end of next week, you will have 6 days. The red line will be below, as long as we don't get a new low point, we will have the red line below 70. If we can trade in this area because by the end of this next 6 days, your high point is going to kind of be like right there at 415. So if we can be around there by the end of the week, kind of fill in this gap, be at that point of control, then we would be set up for a breakout for the green line to get to 100, and then potentially a breakout of this channel width to the upside instead of to the downside. So that's how important we really, next week really is. Like, this can't be a fake out. And the problem is it's susceptible to one, because this is not a runaway gap, right? That gap you see down there is nothing different than we haven't seen before, right? It was a gap of 0.5%. Since that exhaustion gap on February the 2nd, which is right here, that's the exhaustion gap that we had. Since then, we've had 3 gaps bigger than what we saw this morning. This is the biggest gain that we've had since then, but it's the third 1% move, and it wasn't a 2% gain, which is what you like to see. You like to see a strong, when you get a runaway gap, you like to see a standard deviation gap, a significant gap to the upside, and then a close of 2% higher or lower. Just like we had over here, right? This was the runaway gap to the downside. We finished down 2% with a 1 standard deviation move to the downside. That had all the makings of a runaway gap. And as soon as we gap down, we keep going. So we did have that factor. So and nothing, of course, is 100% technical analysis. So for all we know, this very well could still be a runaway gap. But it had the one factor that it ran away from the open. But it didn't have the other factors of having a very significant gap. And that, because, you can see, like, this is a pretty obvious gap that stands out to you, and you run away from the open. It was significant. It was a big move. Here, that doesn't really stand out to you, not like some of these others. And we did run away from the open, and it was a pretty big gap, but it was capped by this gap, right? So, again, Monday, Tuesday, fill that sucker in, we're fine. If we hold it, and assuming this is then a common gap, which is more likely to get filled, then that means by the middle of the week, there's actually a pretty decent probability we fill in that gap. And that's the last thing we want to see, right? The last thing, if we're going to be bullish and we're going to take off here and avoid another fake out, the last thing we want to see is that gap getting filled in anytime soon. All right, now let's take a look at the VIX. And this is another interesting element to today. So the VIX dropped hard. It didn't drop to, it didn't finish at its lows of the day, but ended up dropping hard. You can see by the end of the day, just basically at 18.5. We hit 18.5 before, back over here on January the 19th, and you can see where the VIX closed relative to the VIX 3M, a lot lower than where we're at right now. And then over here we close at just at 19, so pretty similar breakdown, 2-day breakdown below 20 like we have here. And we ended up below 85, a lot lower than even then or now. So the VIX, even though it's kind of at equal levels to what we've seen in the past, is still pretty darn high relative to VIX 3M. And if you look at the VVIX is extremely low. In fact, when you go out to let's go out to like a weekly chart over the last 20 years to go back as far as we've got the data on this. You have to go back out to 2013 into 14 when we were full-on QE3 mode to have the volatility of the VIX be this low. But keep in mind, here in 13 and 14, to give an idea of how low the VIX was at the time, it was here in, so here's 13 and 14 over here, we were well below 15. In fact, in 14, we had gotten down to 10. We're not well below 15. We are barely below 20 with the VVIX, as extremely low as it is. So it kind of gives you an idea just how crazy this kind of market move has been. And then I showed you the correlation. So this chart over here, let me zoom out. You can see how much time we spent. This is only the 10-day correlation, 2 weeks. You can see how much time we spent below 0 and really how much time we spent below this 0.5 mark. If I were to zoom this out to like a full quarter, which is a typical time frame I look at here with this, and let me zoom all the way out on this so we can see some context as much as we can. Again, there's the 0.5% mark. Again, anything below 0.5 is a very weak correlation, which, as you can see in the past, has led to moves to the upside in volatility, right? You can see after continued decline to that August peak, big move to the upside. Over here on this peak, big move to the upside. Over here, after dropping down, we eventually led to this move to the upside. And so, and you can see some other examples after a couple of drops there. This big move to the upside here. So this is a pretty dramatic, and it's all the way to zero. It's a pretty dramatic drop. In fact, it got down to 0.02. Again, this one got to 0.05, and over here got to 0.05. And both of these instances, when they were this low, led to a jump in volatility pretty hard, and a jump in volatility pretty hard. And so here we go again. We were starting to get a little bit of a jump in volatility. It's been delayed, and now it's a question of how much more delayed this will be. Again, the same thing with what we talked about with the S&P for next week. I mean, we are all the way back down below all these moving averages, but you can also see too, just like that, we are already back down to pretty strongly low levels compared to that 200-day moving average. We're in the 5th percentile for the past year. And if I go out to the past 5 years, we're in the 3rd percentile. So this is one of the lowest levels that the VIX has been in relative to its range over the past 5 years, and how low we've been compared to the 200-day moving average. So it's relatively low. On an absolute basis, it's pretty darn low when you look at how far, again, below that moving average it is. But it's also at a point where it's probably set up for a move higher relative to the VIX 3M, the ratio of VIX 3M, as well as the correlation with the VVIX. And of course, as we've been mentioning, the seasonality of the VIX also leads to this week being a pretty strong move higher. You can see if I were to, let's just go out to the 20-year here. You can see, let me zoom in a little bit. So here's where we're at right now. So we have a day here on Monday that's typically weeks from a seasonal standpoint. But from that 6th on to the 16th, a 10-day period, we have a week and a half, we have a pretty strong rally in volatility. And you can see we are already extremely low relative to the seasonal trends for the beginning of the year. It's not common for the VIX to be down 20% at the beginning of a year here. So we'll see, if the seasonality and the ratio and the correlation with the VVIX, as well as, again, just how extremely low we are just on an absolute basis, how far below the 200-day moving average, if all that's going to lead into something, especially considering, again, just how we finished the week at a low and how big of a down week we just had. I mean, it's one of the bigger down weeks in volatility that we've seen. If you look at it on this chart, and you go to VIX, and you go to the weekly here, you can see it's one of the biggest drops in volatility we've had all the way. We'd have to follow it all the way over here to March of 2022. So nearly a year ago. It's the biggest decline, and you can see some of these other declines. Some of them have been led by, but you can also see they've either started these stretches of declines, or we've had some moves higher in volatility coming off of them. Even some of these others, you can see them move higher in volatility. So we'll see if that ends up being the case this go around. You would expect on Monday, just like pretty much every Monday, we gap up, and then the question is going to be, how far we eventually go after the gap up to the upside. All right, now let's take a look at this move and what's driving this. So let's actually go to the last 2 days of this rally that we've had. You can see Qs, VNQ, SPY up significantly higher. Almost 2.5% for the spiders, almost 3% for the Qs, again, in just 2 days. Everything else kind of muted, but here's the big issue. Long-term bonds, remember on Wednesday, I think it was actually my class on Thursday yesterday, we talked about, and I tweeted out how that stocks and bonds have generally been moving together in the same direction for most of 2022, but they haven't been lately. And the Qs from October to January hit pretty equal lows, but that wasn't the case for everything else. Bonds actually broke below those January lows, and stocks are nowhere near their January lows. And that's been kind of a little bit of a divergence. And you can see, like, now you've got, like, you can see IWM and long-term bonds kind of moving in the same direction. Not so much yesterday. Yields were up, which is, again, but kind of surprising how bullish we were late in the day. But then all day today, yields were down and bonds rallied and ended up catching up to, you can see how far back we were of IWM. They ended up catching up to IWM really quickly. In fact, exceeded IWM briefly before IWM caught back up here late and took off, and then a late push here by yields to the downside. So big move higher. Let's go back to when we got the exhaustion gap on February the 2nd. So from that move since, you can see that bonds were the biggest loser, and then they rallied. And you can see also the Qs were down, and a lot of other, going into these last 2 days. In fact, if you just go without these last 2 days, you can see how, real estate was down, Qs were down, bonds were down, everything was down 5% since that exhaustion gap on February the 2nd. The dollar was up. So you can kind of see now why things have drifted. Now, going back to, the rest of this period, commodities are up 1%. Commodities have been rallying this whole week. Very strong week for commodities. We'll take a look at that in just a second. The dollar's flat. It's been flat all week. That hasn't, changed. Again, stocks were down early, but then this late rally has really pushed up to where now stocks are only down 3%. The S&P, the Qs are only down 4%. Gold down a little bit. So you can see kind of an oversold bounce that we've gotten. Just had to, again, relative to where we were on the 21st, because that's where you've got that runaway gap, right? The exhaustion gap was on the 2nd, but then the runaway gap to the downside started on the 21st. So from that period, going forward from here, so there's your 21st to the down. So there's your runaway gap and the move lower. You can see the S&P is almost back to break even, and so are the Qs, only down 0.5%. They were down 3.5% since that period. Real estate down quite a bit. And you can see commodities are up 2.5%. Again, I don't know if that's necessarily what we want to see. It's kind of a two-edged sword. Commodities had, like I said, a great week this week, getting back above the 30 and the 50-day moving averages and kind of halting this correction that it's been in, getting back to the 17-week moving average, getting back to the top. But again, we've got this double-edged sword. If we break through these moving averages and this volume node and get back above this 23% retracement level, then now we are back into inflationary mode, because that's, higher inflation. I mean, you can see we're back to March 2022 inflation or February 2022 inflation levels, where, again, Ukraine was invaded, and that was the biggest reason why commodities rallied. But now we'd be right back to those levels again. And that's what caused a lot of the issues, at least some of the early issues of inflation, higher inflation this year, when it really ramped up to its peak in March, kind of the last little push. So we'd be back to that. Or if we fail, we're back in correction mode. And again, so it's like, which one is bullish for equities? Neither one of them. Now, if we had corrected during this entire correction on equities and started to bounce off at like the 200-week moving average, then a bounce in commodities would be a lot better, because we'd be at much lower levels. Inflation would be a lot more muted, and we'd be fine. But the fact that this entire time that stocks have been dropping here down to their 200-week moving average, right, and then kind of bouncing up, that commodity still hasn't had their correction, means that if we bounce up right now, then we're still at very strong levels and still have high inflation levels. And again, the dollar, remember that was the big issue. Down a little bit this week, a little bit of a Harami pattern, but you can see it's actually still above the 17 50-day moving averages, and didn't really get as strong of a reversal as you would think. The yields had a big down day today. Didn't have a big down day yesterday, but had a big down day today. They finished the week relatively flat, but we're still at near 4%. We closed last week at 3.95%. So we're still kind of moving higher. The big mover actually today, from a risk appetite standpoint, is actually Bitcoin. Bitcoin was down 6% today, failing at the 200-week moving average for a second straight week, reversing the strong gains that we had there, and breaking down below multiple moving averages, including the 8, 17, 30. They're all converged on top of each other. So it's a pretty significant breakdown, with the MACD almost coming down here. So, I mean, this very, very well could be a little bit of an impending, even if it didn't necessarily impact risk appetite today across other areas of that scale, It might not be the best sign for risk appetite in general, getting back below that 23% retracement, especially if it were to get back below these longer term moving averages that have converged on each other, and then of course the point of control for the past year. So a little bit of one negative sign for risk appetite in general. That, as well as, like I said, the commodity complex moving higher is not the thing we want to see, right? We don't want to see commodities breaking these moving averages and heading higher, because it just leads to, again, higher inflation expectations. That's the whole problem we've been in. That will lead to higher yields. That generally has been leading to a higher dollar as this rides higher and gets back above moving averages and moves up towards 30 again. And this led to more of a correction in equities, right? Higher interest rate hike odds and all that. In fact, if you look at the interest rate hike odds, again, the stock market is up significantly over the last 2 days, right? So going back to March the 1st, you would think, oh, then that probably means we have some pretty significantly lower odds for rate hikes from March the 1st. Well, here's March the 1st. The current odds for being at 5.25% is 28%. 28%. Remember, we're up significantly higher. Right now, on March the 1st, they were at 29%. So we're down a little less, right around 1 percentage point. That's it. And that's, again, the stock market has benefited pretty strongly here. Let's go to May. And you look at May, you think, okay, there's about a 35% chance that we'll be at 5.5. So getting to 5.5 would mean that we've had one of these two meetings is a 50 basis point a hike. So it's at about a 35% chance of that happening. 2 days ago on March the 1st, that was at a 30% chance. So we actually have a higher odds now of getting a 50 basis point hike one of these next two meetings than we did 2 days ago. And yet the stock market's rallied pretty high. Going to June, and you say, okay, where are we at in June? Well, in June, we have to get 1, 2, 3 rate hikes. We're at 84%. That we'll get at least a 25 in June. 84% is where we're at. Well, March 1st, 2 days ago, before we had this 2-day rally, we were at a 83.6%. So nothing has changed. You go out to December and you think, okay, where are we now in December? Like, if we were to get to 5.5%, what's the likelihood we'd still be there? Well, you have about a 70% chance, because you have 30% chance that we'll be at 5.25 or less. So you have about a 70% chance here that you're going to be 70% chance you'll be at 5.5% by the end of the year. So hike, and then nothing, but no cuts all year long. 70% chance. Well, 2 days ago, 5.5% is this green line. On March the 1st, it was a 72% chance. So that's declined by about 2 points. That's it. And the stock markets have rallied. So nothing has changed from the futures market. Now, from the bond market, you can see over the last couple of days, the 2-year yield has gone from, here, let's go to the 5-day 2-year. You can see 2 days ago, going into March 1st, we were right around 4.9%. Now we're at 4.86. So we've come down 4 basis points on the 2-year, which is pretty significant. But if you look at the 10-year instead, pull up the 5-day on the 10-year, we're at 3.95 right now. Well, on March the 1st, we were at 4. So we've lost a whopping 5 basis points in 2 days. Now we went up and then back down, but in 2 days that we've had this great rally in equities, we've lost 5 basis points. In fact, if you look at the spread between the 10 and the 2-year, we are at, 91 basis points is the lowest close that it's had, right? If you have to go back so far to get to 91 basis points, right? So here we are again. The end. This would be the end of March the 3rd at 89, and we see it's at 91 right now. So you have to go all the way back. None of these periods. You have to go all the way back over here to right in this area right in here is the last time we were at 91 basis points, right around there. So 1981. So we're looking at over 82 or 42 years that we've had a yield curve this low between the 10-year and the 2-year. So the short-term bond market, the futures market, says hey, that we understand what the Fed's doing and we're on track. The long-term bond market's like, there ain't no way the Fed's going to do that. I mean, that's what the 10-year is saying. There ain't no way the Fed's going to do that. All aboard this train. And the stock market's grabbed a hold of that. All aboard this train. But again, the futures market and the short-term bond market is like, we don't know what these guys are doing. The Fed is going to raise rates 3 more times. They're going to keep rates longer. They're going to get that real Fed funds rate up to positive levels, which right now is at 2%. To get it to positive levels, the Fed funds has got to get above the CPI, and right now the year-over-year CPI is at 6.34%, and it's expected to, over the next couple of months, drop to 5.3%. So by the time we get to the March meeting, it will be right around 5.5%, and we will just be getting to 5. But you notice the core CPI will be higher, is expected to be higher than the headline CPI for the first time in a long time. And you can see it's actually expected to increase. The core CPI is expected to move up. The core PCE is expected to move up. That's not necessarily what the Fed wants to see. And so that's an issue that I think that the short-term bond market's realizing that the long-term and stock markets are like ignoring. And I think that's going to be an issue going forward, trying to build on this, because eventually, I mean, it's not like this is hidden knowledge. Eventually, this is out there, and it's going to come home to roost. In my opinion, it will come home to roost. And a lot of what we've seen in the last couple of days, again, a lot of the fake out signals we see will eventually play themselves out again. All right, let's take a quick look at the sector moves, and let's do the same thing. Let's look at how they performed here today, or last 2 days. And you can see, I mean, look at that. Like, okay, technology, communication services, I understand. Even discretionary was down with financials yesterday, but then rallied here today, right? And we kind of know why, earnings and Tesla and their investor day, right? But now they're down, up 2%. So, okay, financials, not lagging behind. That's not necessarily what you would expect with staples and healthcare, but to see utilities with the best gains of the past 2 days, outpacing technology, outpacing communication services, with real estate outpacing materials, energy, and industrials, economic growth sensitive areas. That, again, it has a lot to do with yields dropping back down. They didn't drop down yesterday, and utilities were higher with staples. On that day, on this bullish day, you had utilities and staples up there. Staples ended up coming down, but utilities kept going up. You got to wonder about the strength of this sector when those are the areas, or strength of this move in the last 2 days at least, when those are the 2 areas that lead the move higher. You can see part of the reason why they led the move higher because they were the biggest oversold, one of the biggest oversold levels. You can see utilities had an overbought cluster. I mean, they were really hammered since yields started to rally on that, especially real estate, when yields started to rally after that exhaustion gap in the stock market. You can see industrials at 3-month highs, materials near 3-month highs, technology near 3-month high. I mean, everything kind of looking like a little bit of a bounce signal, like we're kind of expecting the market to look like. And it's not just in the U.S. If you look at other markets, of the main markets that are out there, you can also see very similar patterns in Europe especially, but look at Italy at 3-month highs, France near 3-month highs, UK near 3-month highs, Germany technically is near 3-month highs too. China's not close yet, Korea's not close, and India are kind of giving you like signals that we could bounce down from here. So that's why, again, not necessarily completely sold on this rally yet until you see more dark green shading and green line across the board from a sector standpoint as well as from an international standpoint. All right, let's take a look at our trade idea for today, and I'm going to take a look at a stock in the energy sector, Halliburton. You can see Halliburton made its way up to the moving average. Got a bear tag, which means, again, we close above falling 30-day moving average after having been below it, and your intermediate line is rising, but it's not in the upper half or in bullish territory yet, still in bearish territory. So you have light green shading because of that, and you have the yellow line because we're slightly above 30-day moving average. So again, this can either be a really bullish scenario like it was over here that starts a new intermediate run to the upside, or it could be a sell signal, and we can continue what has been a bearish move more down to the downside. And we're going to be looking at the latter in this particular case. Let's take a look at, let's go to the weekly chart first. All right, on the weekly chart, you can see, again, we have a transition candle. We've had some bearish candles. We have a transition candle. If you take a look at the actual candle itself, it is relatively bullish. So there's an opportunity for this to be a move to the upside, especially if we close this week up above this body. You can see the Hakunashi candle has turned slightly positive, the small bullish candle, but your PPO is actually still falling. It's still really, really high, relatively speaking, and it's still falling. Again, not necessarily the level, especially considering how like overbought the stock is, how overbought the commodities are. If I were to zoom out a little bit, you can kind of see the strong rally this has been in since its decline over the course of this 18 to 19 year, when we were kind of in a global slowdown. Again, masked in the U.S. by the strength in FANGs, as FANGs had been a safe haven during that period of time. When you take a look at the 3 green arrow chart for Halliburton, we do have 3 green arrows. So again, 3 green arrows can either be a buy signal and start a new bullish run like we had right here, same thing, or they can be the sell signal if it only lasts one day. And again, that's the direction we're leaning, partly because of what you see right here. We are sitting right at the 30 and 50-day moving averages, and really unable to break through multiple moving averages. If we had broken through the 17 and the 30 at the same time, we'd feel a lot stronger about it. But we broke through the 17 one day, the 30 the next day, and still just trading in between lines would suggest that we are more than likely, here, let me remove this drawing, that we're more than likely going to kind of hit some resistance in this area, kind of a head and shoulders top kind of a move, especially with the MACD still bearish and stochastics not in bullish territory. You also see some of these other indicators not really breaking out either. The directional movement index, it's still pretty negative on the DMI. When you look at the RSI and the CCI, which have been in bearish territory, they're strong, but they're not exceeding 150. We're not exceeding 60. We're above 0 and above 50, but we're not entrenched at bullish levels, kind of in the no man's land, kind of the sucker zone. We are up above 80, but you notice how quick this bounce has been. This has in the past been, again, an opportunity for a reversal to the downside when it moves that quickly to the upside. Here's your Ichimoku cloud. We are above the blue line, but we're in the cloud, and we still have a negative rate of change, and will still continue to have a negative rate of change, barring a significant move. So you can see how there's still some, as bullish as we've been, you can see how we're still relatively bearish from that perspective. We're not in the upper quartile. We're in the upper half of the range, but we're not in the upper quartile of the bandwidth, excuse me. And you can see we have after some negative momentum, we have the bands inside the Bollinger Bands, but we never, again, we're not anywhere near threatening the bullish bands. And again, if we do, like I said, if this does turn into a bullish move, we'll know pretty quickly, right? Because that's the thing about bear tags. They you either turn into a bullish move pretty quickly, or you bounce down. Like, we'll know really quickly if this turns into a bullish move or not. And so what I decided to do on this trade is we came down and sold the 30 what was at the time the at the money put. So we bought the 38, sold the 36, a little bit out of the money, not very much. You can see it's pretty much where we got into it here. Let me get rid of there we go. So bought the 38 put, sold the 36. So that's how far down we have to go. So it's not very aggressive, but that's how far it needs to get to for us to get to our break even and beyond for a maximum gain, that's about 2 times what we're willing to lose. But like I said, if we rally up to 40, 41, then we know that bear tag's not going to play. It's going to play out to a more likely to a bullish move, and we can take a $150 loss with a $1,000 gain rather than the full $500 loss. Knowing that if it does break down, then we get a pretty good reward for that small amount of risk that we're knowing, again, because we're right at that inflection point. When you're trading right at that inflection point, that's when you really get your best reward to risk scenarios there. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Like us and follow us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.